Okay, let's unpack this. We're diving deep into a fascinating report on the Asian Real Estate Investment Trust, or REIT, market in 2024.
Hmm.
Our source today is excerpts from a research report by Cushman and Wakefield, giving us a detailed look at how these markets performed and are evolving. The mission,
Yeah.
to extract the most important insights, understand the key trends, and get you well informed on this dynamic corner of the real estate world without getting lost in the weeds.
Indeed. This report offers a landscape view across Asia, but it zooms in with a particular focus on the more mature markets of Japan, Singapore, and Hong Kong.
Right.
Alongside the rapidly developing China mainland infrastructure REITs market, often called C-REITs, we'll be looking at how their sizes shifted, key financials like, leverage and yields, and even getting into the operational details of the properties themselves.
So buckle up for some surprising facts and hopefully a few aha moments as we explore the numbers and stories shaping Asia's REITs.
Let's do it.
Diving right in, the report really sets the stage for 2024 by characterizing it as a year defined by structural change and divergence within the Asian REIT market.
Yeah.
What does that big picture look like in terms of size?
Well, as of the end of 2024, there were 263 active REITs across Asia with a total market capitalization of, $235.8 billion.
Okay.
Now, interestingly, that was down 6.5% from the end of 2023 overall.
But here's where it gets really interesting. Despite that slight overall dip, there was a kind of tectonic shift, wasn't there?
Yes, a huge one. For the first time, China mainland's REIT market capitalization actually surpassed Hong Kong's.
Wow.
A significant milestone, positioning China mainland alongside Japan and Singapore as one of the top 3 markets by size in the region.
Right.
Together, these 4, Japan, Singapore, China mainland, and Hong Kong, now represent over 80% of the total Asian REIT market cap.
So you have the overall pie shrinking a little, but the slices are rearranging dramatically. The traditional mature markets, Japan, Singapore, and Hong Kong, saw their market caps shrink. What was hitting them?
Primarily factors like falling REIT unit prices and currency fluctuations against the U.S. dollar.
Makes sense.
While the mature markets contracted, the emerging markets, including China mainland, Thailand, India, Malaysia, and the Philippines, saw their market caps expand.
And the scale of that expansion in emerging markets is pretty striking in the numbers. China mainland saw the biggest leap, up a massive 85% year-on-year.
Huge jump.
Contrast that with Hong Kong's largest decrease, down 24%, Japan down 17%, and Singapore down 11%. Meanwhile, elsewhere in emerging Asia, Thailand grew 41%, the Philippines 37%, Malaysia 21%, and India 13%. That's quite a divergence.
It really highlights that even within a seemingly unified market like Asian REITs, different forces are at play. We see macro factors like the U.S. Federal Reserve's rate cuts 3 in late 2024, according to the report.
Right, 3 cuts.
Influencing sentiment. But the slower pace of those cuts, the broader political environment, and crucially, local monetary policies led to widespread price declines in the major globally integrated markets.
And then there are micro factors specific to assets or sectors. Singapore, for example, saw increased equity financing and M&A activity despite price weakness.
Exactly, particularly in data center and hotel office assets that performed well. Japan saw distribution yields tick up, and hotels there were particularly strong performers thanks to the tourism boom.
And they even mention AI, right?
Yes, it's fascinating how the rise of artificial intelligence is specifically called out as driving interest in data centers, with Japan noted as Asia's second-largest data center hub.
Interesting.
This brings us back to that core theme for 2024. Mature markets were largely focused on managing their existing assets and strategically selling off properties, to handle financial challenges and find niche growth.
Right, managing and disposing.
Emerging markets, on the other hand, were all about expansion, seizing development opportunities, and bringing new products to market. Data center and accommodation hotels were definitely the star asset types across the board.
It's worth noting the historical journey, too. This market wasn't always this big. The report traces its growth from just 70 products totaling, $1.7 billion in 2001?
Tiny, relatively speaking, up to 263 products and $235.8 billion in 2024. It actually peaked higher, $309.5 billion in 2021, before this recent pullback.
Okay.
And looking at the composition today, composite REITs holding multiple property types are the most numerous with 90.
Right.
Industrial logistics is next with 45, followed by office, 34, retail, 33, and accommodation, 30. Other types like infrastructure, sustainable healthcare, and data centers are fewer, but represent, newer areas of focus.
The report points out that industrial logistics and retail actually saw the most new REITs added in 2024 across Asia. So even in a challenging year, expansion was happening in specific sectors.
That's right. Now, let's zoom in on those mature markets, Japan, Singapore, and Hong Kong, using some key financial metrics from the report. We'll look at leverage, yield, total return, and price to book. Just to frame it, Hong Kong is still grouped with mature markets here for comparison purposes, even though China Mainland's market cap is now larger.
Got it. First up, leverage ratio. This is how much debt a REIT is using relative to its assets, right? A measure of financial risk and potential return enhancement.
Exactly. And regulation plays a huge role here, creating key differences. Japan, for instance, has no explicit regulatory limit, which tends to result in a higher average leverage across its market.
No limit. Interesting.
Hong Kong has a firm maximum of 50%. Singapore historically had a slightly lower 45% limit, but this was relaxed in November 2024, moving to a unified 50% limit with a lower interest coverage ratio requirement.
Why the change in Singapore?
That move was explicitly aimed at increasing flexibility and competitiveness, particularly helpful in a higher interest rate environment.
Right.
Compare that already to China Mainland's much lower limit, which we'll get to later.
Okay. So what were the average leverage numbers for these mature markets in 2024?
Japan averaged around 45.2%, a slight tick up. Singapore was around 39.3%, up 1.2%. Hong Kong was the lowest at around 30.7%, up 0.6%.
Still quite low relatively.
Yeah, and the report notes its average is pulled down by many REITs using significantly less debt.
Are there interesting variations within these markets based on asset type or specific situations?
Definitely. In Japan, some apartment REITs are pushing above 50% leverage, while others, like some industrial, hotel, and retail REITs, are below 40%.
Okay.
In Singapore, a couple of office REITs were above 45%, and the report highlights Manulife U.S. REITs specifically exceeding 50%, largely because the value of its U.S. office assets declined.
The U.S. office market impact.
Precisely. In Hong Kong, while the average is low, some composite and the single hotel REIT were above 40%. Some HK REITs also got creative to manage financing costs in a high HKD rate environment, like UXU REIT's efforts to switch to lower rate RMB loans for some assets.
Smart. Looking across these mature markets by asset type, the report confirms Japan's apartment REITs typically have the highest leverage, often over 50%.
Yeah, generally. Retail, hotel, and industrial logistics are generally lower, maybe in the 40-41% range.
In Singapore?
In Singapore, office REITs showed the highest average leverage increase, hitting 45%, and data center REITs also saw an increase. Hong Kong's single hotel REIT had higher leverage than office and retail, which were, below 30%.
So it really varies.
It really does. Leverage isn't just about the market average. It varies significantly by asset type and individual REIT strategy.
Okay, next key metric, distribution yield. This is the dividend paid over the past year relative to the current stock price, essentially, the income return you get as an investor.
Right. For 2024, Hong Kong had the highest average yield at 8.3%, though it's down slightly, about 20 basis points.
8.3%, pretty high.
Singapore was 6.9%, also down a bit, 16 basis points. Japan was 5.4%, but notably, it was up significantly by 91 basis points from 2023.
Wow, almost a full percentage point increase in Japan's yield. That's interesting, especially considering prices fell across all three markets. Hong Kong down 23%, Singapore down 12%, Japan down 9%. Why did Japan's yield go up so much while the others dipped slightly despite falling prices?
It means that in Japan, the price declines were significant enough and/or distributions remain relatively stable or even increased to push the yield up considerably.
Okay.
In Singapore and Hong Kong, it seems challenges in underlying asset performance likely led to distributions being reduced, which offset or, outweighed the effect of falling unit prices on the yield calculation.
Got it. The report also uses the yield versus 10-year government bond spread. How does that look? What does that tell us?
Yeah, this spread is a way to measure the risk premium investors are getting from REITs compared to a relatively risk-free government bond.
Okay, the premium.
Hong Kong's spread was 4.8%, pretty stable from 2023, which makes sense with its interest rates following the Fed.
Right.
Singapore's spread narrowed to 3.9%. That suggests less risk premium relative to bonds, potentially making them less attractive purely on yield. Though the report notes lower PB ratios might compensate for that.
Okay. And Japan?
Japan's spread actually widened to 4.5%, up from 4.0% in 2023. This happened as both bond yields rose. Remember, the Bank of Japan started hiking rates and REIT yields increased.
So a wider spread. More attractive on yield.
Potentially, yes, on a relative yield basis, but it also reflects the market volatility there.
Makes sense. Looking at yields by asset type, you mentioned office REITs saw a decline, especially in Singapore, linked to U.S. assets.
Exactly. The report connects it to the performance of U.S. office assets held by some Singapore REITs, like prime U.S. REITs. Industrial logistics REITs now slightly edge out office in average yield across these mature markets.
Interesting shift.
Data center yields saw minor dips in Singapore. On the positive side, retail, hotel, apartment, and healthcare yields increased. Hotel specifically saw a significant rise in yield, 1.8% in Japan, driven by that tourism boom.
Right, tourism effect.
And 1.6% in Singapore.
Moving to total return. This is the overall return for investors, right? Combining price changes and distributions. The report uses the major market indices like Tokyo Sei REIT Index, IEDS REIT Index.
And the Hang Seng REIT Index, yeah.
So how did they fare in 2024?
It's a mixed bag. Japan saw negative 4.6% total return. Singapore was actually positive, plus 3.0%. And Hong Kong was down significantly, negative 16.4%.
So Singapore was the only one with a positive average total return. What drove that?
Breaking it down by asset type within Singapore, data centers performed best, up 9.7%. Healthcare was also strong, plus 6.9%.
Right.
Retail and office returns were still negative, but they showed improvement from 2023. Composite returns worsened, and interestingly, industrial logistics turned negative in Singapore for total return.
Got it. Finally, price-to-book ratio, or PB. This compares a REIT's market price per unit to its net asset value per unit. Tells you if the market values it above, 1, premium, or below 1 discount the asset value.
And the big picture here for mature markets at the end of 2024 is that all three were trading at a discount.
All three below book value on average.
Yes, and that discount actually widened compared to 2023. Hong Kong had the deepest discount at 0.32.
Wow, 0.32?
Singapore was at 0.74 and Japan at 0.81. This contrasts sharply with what we'll see in China mainland later.
Can you give us some examples within each market? Any standouts?
Sure. In Japan, with its 0.81 average, most REITs were trading between 0.7 and 0.9. The standout premium was a hotel REIT, Ichigo Hotel REIT, at 1.75, focusing on major cities.
So one premium example.
Yeah. The deepest discount was an office REIT, Sankai Real Estate REIT, at 0.65. In Singapore, 0.74 average, several REITs were below 0.5 PB. The highest PB, trading at a significant premium, were shared by a data center REIT, capitalization rate at 1.6.
1.6, strong premium.
And a healthcare REIT, Parkway Life REIT, also at 1.6. The lowest was a retail REIT, Dasen Retail Trust, at a very low 0.05, holds assets in China mainland, faced debt issues.
Right, that explains the low PB. And Hong Kong?
Hong Kong, 0.32 average, reflecting that persistent deep discount. The highest PB was a logistics REIT, SF REIT, but still only at 0.60.
Still well below book.
Exactly. The lowest was the hotel REIT, Regal Real Estate Investment Trust, at just 0.12.
So even within markets trading at a discount overall, some asset types are clearly more favored by investors, like data centers and healthcare.
Absolutely. Summarizing PD by asset type across these mature markets, healthcare and data centers generally commanded the highest average PB, often above 1.0, reflecting investor confidence. Most asset types saw their PB decline, though.
But data centers in Singapore buck that trend.
Yes. Notably, data centers in Singapore saw their PB ratio increase significantly, again highlighting strong investor confidence. Keppel DC REIT's PB went from 1.40 to 1.60, for example.
Wow.
In Japan, hotel REITs had the highest PB among asset types, 0.89, and saw the smallest decline. In Hong Kong, industrial logistics saw a small increase in PB, while others, particularly composite and retail, faced further discounts.
Okay. Before we jump fully into China mainland, let's look at how REITs from Singapore and Hong Kong are already connected through holding China mainland properties. The report covers this specifically.
Yes, it's a significant connection. As of March 2025, 16 REITs, 10 from Singapore and 6 from Hong Kong, collectively hold 132 properties in China mainland.
132 properties. That's substantial.
It represents a significant portion of the listed REITs in Hong Kong, about 55%, and Singapore, about 26%.
And where are these assets located? The report breaks it down by city tier, right? Like Tier 1, Tier 2.
Exactly. Over 70% are concentrated in Tier 1 cities. Think Shanghai, Beijing, the big hubs, that's 27%. And major Tier 2 cities, large provincial capitals, economic centers at 45%.
So a clear preference for the bigger, maybe more stable areas.
Definitely shows a preference for areas perceived as more stable or having higher growth potential. Some assets are in other Tier 2 and Tier 34 cities as well, but the focus is clear.
Is there a difference in preference between the Singapore and Hong Kong REITs holding mainland assets?
Yes, there is. Hong Kong REITs show a stronger preference for Tier 1 cities. 60% of their mainland holdings are there.
Why is that?
Largely because their assets there are primarily office, retail, composite, and hotel, which tend to perform best in the top-tier economic hubs.
Makes sense.
Singapore REITs are more spread out across tiers, only 14% Tier 1, but 53% in major Tier 2. The report explains this is partly because over half their China mainland holdings are industrial logistics assets.
Logistics doesn't always need to be downtown.
Exactly. They're often located based on proximity to industry clusters or transportation hubs rather than just city size. Mapletree Logistics Trust is cited as an example, with mainland assets in 27 different cities.
Wow, 27 cities. What are the most common asset types these overseas REITs hold in China mainland overall?
Industrial logistics dominates, accounting for 46% of the properties. Retail is next at 28% and office at 14%.
Was there much transaction activity involving these mainland assets in 2024? Acquisitions? Sales?
Interestingly, the report notes there were no acquisitions of China mainland properties by these Singapore or Hong Kong REITs in 2024.
Not at all.
No acquisitions. However, there were two notable disposals of older properties. These sales were explicitly aimed at freeing up capital to potentially reinvest in newer, higher potential assets elsewhere.
Recycling capital.
Pretty much. Mapletree Logistics Trust sold an older logistics facility in Zhejiang, and Dasen Retail Trust sold an older office building in a prime Shanghai location.
Okay, now let's jump into the market that's rapidly changing the landscape. China mainland infrastructure, public REITs, or C-REITs. It's only been developing for about 4 years, but the report paints a picture of really fast growth.
It certainly has been fast. 2024 was a peak year with 29 new products listed and over 65 billion issued. The report states the market has firmly entered a regular issuance phase.
Regular issuance phase, and what's the scale now?
As of March 21st, 2025, there are 64 listed products. Total issuance scale, including reissuance, is 174.8 billion, and the total market cap is 186.0 billion.
Okay, 186 billion market cap. How is that broken down by the type of underlying right, property rights versus usage rights?
Right? 40 are property rights products, where the REIT effectively owns the asset, like a building.
Okay.
And 24 are usage rights products, where they hold the right to revenue from the asset for a specific period, like a toll road concession.
Got it. The report highlights increasing diversification in asset types, especially in 2024. That seems key.
Yes, this is a major trend. Consumer infrastructure, think shopping malls, department stores, made its debut with 7 products and nearly 20 billion issued in the year alone.
Big debut.
Yeah. New types like water conservancy and heating were added under municipal infrastructure. Park industrial, warehousing logistics, clean energy, and toll roads continued to see new issuances. This broadening of asset types is crucial for market maturity.
How does the C-REIT market stack up against other Asian markets now, in terms of size and number?
China mainland now has the most listed REITs in Asia by quantity, surpassing even Japan and Singapore.
More products listed. Interesting.
But its market cap, while growing fast, is still smaller than Singapore and Japan, making up about 9.1% of the total Asian REIT market. So lots of products, but smaller average size still.
Policy support seems like a huge driver of this rapid development.
Absolutely. The July 2024 regular issuance notice was a significant signal. It moved the market beyond a pilot phase and expanded the eligible asset categories to 12.
12 categories now.
Yeah, adding things like elderly care, market-based rental housing, coal power, and even allowing components of hotels and retail in certain projects. It also simplified application procedures to speed things up.
Streamlining the process.
Exactly. And exchanges also issued guidelines to standardize disclosure and protect investors. This top-down support is clearly fueling growth.
So the future potential looks strong.
Based on the report, yes. The move to regular issuance, the increasing diversity of assets coming online, and improving mechanisms for follow-on offerings provide a strong foundation for continued expansion.
Let's dig into the issuance details a bit more. You mentioned 29 new listings in 2024. What were the average sizes like?
Overall average issuance is around 2.7 billion. For the 2024 new listings, property rights products averaged 2 billion, slightly down from the prior year, with consumer REITs having the highest average size at 2.8 billion among that group. Usage rights products averaged $2.8 billion, with toll roads notably higher at $4.4 billion on average for new issues.
And how does the total issuance scale break down by type across the whole market since inception?
Of the total $174.8 billion issued, toll roads are still the largest segment by far, accounting for 39% or $68.8 billion.
Still dominant.
Yeah. Park industrial is next at 15%, $25.9 billion, and consumer infrastructure, despite its recent launch, is already 12%, $21.3 billion.
Catch you up fast.
Very fast. And looking at market cap as of March 2025, toll roads are still the largest at 33%, $61 billion. But what's fascinating here is that consumer infrastructure actually overtook park industrial in market cap during the first quarter of 2025.
Overtook them. Wow.
Yeah, becoming the largest property rights type by market cap at 15%, a $28.4 billion. That shows how quickly investor interest can shift to new favored sectors.
Definitely. Let's talk about market cap and price performance for C-REITs. The report notes trading activity is picking up.
It is. The daily average trading volume in 2024 was $420 million, a healthy 34% jump from 2023's $320 million.
Good increase.
And Q1 2025 saw it climb even further to $690 million. This suggests increasing liquidity and investor engagement. The average daily turnover increased from 0.8% in 2024 to 1.0% in Q1 2025.
And how have the unit prices performed relative to their initial issuance price?
Yeah.
Gains,
Oh,
losses.
pretty strong gains, actually. As of March 34, 2025, the average price gain across all 64 listed C-REITs, including dividends, was a robust 26% from their issuance price.
26% average gain. Nice.
Property rights products gained 24% on average, and usage rights products gained 27%. So pretty consistent gains across both types.
Are there big differences in price gains by asset type within C-REITs? Must be some variation.
Absolutely, and this is where the underlying asset story really starts to matter. Energy infrastructure saw massive gains, up 48%.
Wow, 48%.
Affordable rental housing was up 46%, water conservancy up 45%, and consumer infrastructure up 39%. These are the high flyers, showing significant premiums over issue price.
Okay, and the lower end.
On the lower end were park industrial plus 14% and warehousing logistics plus 16%. Toll roads had the lowest average gain at plus 10%.
Only 10% for toll roads.
Yeah, which the report links to macroeconomy impacts and even weather affecting traffic flows. Though it points out outliers like Zongjin-Shandong Toll Road, which was up 36% due to better than expected performance.
So performance really matters.
Exactly. This divergence really reinforces that asset operation is a key driver of unit price volatility and performance in this market.
What else is driving this positive price performance and increased trading activity, besides asset performance?
The report points to a few things. The external market environment plays a role like, global uncertainty, falling bond yields elsewhere. International risks make the stable dividends offered by REITs, especially infrastructure ones, look attractive.
Safe haven appeal.
Sort of. Then there's the C-REIT market's own expansion and increasing maturity, more choices, diversification for investors. The diversified underlying assets naturally perform differently across economic cycles, and the evolving investor structure, with a rising share of institutional investors, is leading to more active trading.
Makes sense. The report also looked at the correlation between the C-REIT index and the broader stock market index, the CSI 300.
Yes, and this is quite telling. Historically, the CSI REITs index and the CSI 300 index have been pretty closely correlated.
Right.
But in 2024, there was a significant divergence. The correlation dropped sharply from 0.9 in 2023 to just 0.1.
0.9 down to 0.1. That's huge.
Massive drop. It suggests C-REITs showed much more resilience and performed more independently from the broader stock market in 2024, likely driven by their improving underlying asset operations and strong investor demand for yield in a low-rate environment.
And that continued into 2025.
Yeah, the CSI REITs index continued this positive trend, rising 9.1% in Q1 2025.
Let's talk about leverage ratio specifically for C-REITs, because you hinted earlier it's very different from mature markets.
It is a stark contrast. China Mainland has a strict maximum leverage limit of 28.57% total liabilities to total assets.
That's lower cap.
Much lower. And a crucial difference from overseas markets is that no external credit enhancement is allowed.
Okay. And how much leverage are C-REITs actually using within that limit? Are they maxing it out?
Not even close, generally. As of March 2025, only 12 out of the 64 REITs use any external leverage, and all of those are below 20%.
Only 12 out of 64 using debt.
That's right. Property rights REITs using leverage are mainly in consumer infrastructure and park industrial. Usage rights REITs using leverage are mainly toll roads.
So average leverage for those using it is maybe around 11% for toll roads and park industrial and 15% for consumer infrastructure.
Roughly, yes. Compare that to average leverage levels of 30–45% in mature markets. China mainland C-REITs are using significantly dramatically less debt.
What's the implication of that low leverage?
Well, this cautious approach definitely helps market stability and lowers risk for investors. However, it also limits the ability of these products to enhance returns or accelerate growth through financing strategies common in more mature markets. It's just a different risk-return profile baked into the structure.
Got it. Moving to distribution yield for C-REITs, based on March 31st, 2025 prices and 2024 distributions. The report mentions usage rights products tend to have higher yields. Why is that again?
Primarily because the underlying usage rights, like a toll road concession, have a defined, often shorter remaining life compared to owning a property forever. So more of the cash flow needs to be distributed back to investors over that limited life.
Right, the payback period is shorter. What's the current average yield across the C-rate market?
Around 5.6% across all 64 products. The report notes this is lower than the initial expected yields when they were launched,
Why lower?
mainly because the unit prices have risen significantly since launch. Higher price, same dividend, lower yield percentage.
Okay. How does it break down? Property rights versus usage rights.
Property rights products average 4.0% yield now, down from an initial forecast of 4.9%. Usage rights products average 7.8% yield, down from an initial 9.3%.
Okay. Breaking down the yield for property rights REITs specifically. Any standouts there?
Warehousing logistics offers the highest average yield at 4.5%, relatively stable compared to initial forecasts. Affordable rental housing is the lowest at 3.1%.
3.1%, quite low yield.
Yeah, and it's down from an initial 4.1%. The report attributes this low yield to the high premium investors are paying for its perceived stability. Price goes up, yield comes down.
Right, the premium effect again.
Consumer infrastructure is at 4.2%, down significantly from an initial 5.7%, also reflecting a high premium. Park industrial parks are between 4.0% and 4.3%, down from initial forecasts.
And logistics initial forecasts went up.
Interestingly, yes. The report highlights that initial yield forecasts for warehousing logistics actually rose in 2024, reflecting higher investor risk expectations for that sector at the time of listing.
And how does the C-REITs yield compare to the 10-year government bond spread? That comparison was interesting for mature markets.
Yeah, the report calculates the spread for China mainland property rights REITs, that 4.0% average yield, minus the 2024 average China government bond yield, around 2.2%, giving a spread of about 1.8% as of March 31st, 2025.
So comparing that 1.8% spread to the mature markets, Hong Kong at 4.8%, Singapore at 3.9%, Japan at 4.5%, the C-REITs yield spread is noticeably lower. What does the report say about why this difference exists?
The source suggests several reasons that tie back to the structural differences we've discussed. One, mature markets are generally trading at a discount to NAV, which naturally boosts their current yield calculation.
Right, lower price boosts yield.
Two, C-REITs use much less leverage, limiting their ability to financially engineer higher yields. And three, the asset mix differs. Overseas markets have a higher proportion of commercial properties like office and retail, which can offer higher yields but often come with higher risk compared to the infrastructure focus of C-REITs.
Okay, that makes sense. Let's look at price-to-book ratio for C-REITs, again based on March 31st, 2025 data. We saw mature markets are trading at deep discounts. Is it the same for China mainland?
No, and this is another key point of divergence. The average PB for C-REITs is 1.24.
1.24, so above 1.
Yes, meaning the market is generally trading at a premium to net asset value. Only 6 out of 64 REITs were trading at a discount, mainly in park industrial and toll roads.
Big difference from the mature markets.
Huge difference. Property rights REITs average 1.23 PB, and usage rights average 1.25.
So a clear premium valuation compared to mature markets. Breaking down that PB by type, which sectors command the highest premium?
Affordable rental housing has the highest PB at 1.42.
Makes sense given the price gains.
Reflects its strong price performance and investor willingness to pay a premium for perceived stability and counter-cyclical nature. Consumer infrastructure is also high at 1.37, with specific examples like Huaxie Shouchuang Outlets REIT hitting 1.56,
Wow.
showing how differentiated asset performance drives valuations.
Yeah.
Park industrial, 1.13, and warehousing logistics, 1.15, are lower among property rights. The report notes pricing divergence within park industrial REITs listed at different times.
And usage rights PV.
Among usage rights, the new Water Conservancy REIT was highest at 1.44, while toll roads had the lowest PB at 1.13. It's worth noting that PB can be higher for usage rights products because the NAV of the underlying right decays over time as the concession shortens.
Right, denominator shrinks.
While the market price might not decay at the same rate if operations are strong.
The report also touches on the investor structure for C-REITs. Yeah. There's a specific requirement for original sponsors, right? They have to hold a stake.
Yes, the original sponsors or their affiliates have a strategic placement requirement, holding a minimum of 20% of the initial issuance with phased holding periods. There's also a tax deferral incentive for holding long-term.
Trying to align interests.
Exactly. It's designed to align the interests of the sponsors with the long-term performance of the asset.
What are the average holdings for these sponsors? Is it just the minimum 20%?
No, it's usually higher. Original sponsors affiliates hold about 34% of property rights products on average. It ranges from 25% for industrial parks up to 41% for consumer infrastructure.
Higher for consumer infra.
Yeah, the report notes higher initial sponsor holdings for early consumer infra REITs were likely used to build confidence in this new asset class.
Okay. And for usage rights.
For usage rights products, sponsor holdings are higher overall, averaging about 46%, reaching 48% for toll roads. The report suggests this might be for greater control over assets with more uncertain revenue profiles, or simply to signal confidence in new types.
And the report points out that many sponsors actually increased their holdings in 2024, buying more.
That's right, likely as a signal of confidence in the market or their specific REITs during a period of expansion and maybe some price volatility.
Okay, what about institutional investors overall?
The report gives the overall institutional investor share in C-REITs, which was about 96% at the end of 2024.
96% institutional. That's very high.
Yeah, notably higher than overseas markets, which are typically in the 80–90% range. And that share increased across most asset types in 2024, contributing to the more active trading we saw earlier.
Okay, interesting structure.
Now, beyond the financial metrics, the report gives us a look at the ground level, the operational performance of the underlying assets for property rights C-REITs. This is really getting into the nitty-gritty.
Yeah, how are the actual properties doing? They analyze occupancy rate, rent per square meter, and collection rate.
Exactly, for 92 assets from 2022 through 2024.
Let's start with industrial parks, covering 29 assets. How are they performing operationally? Occupancy.
Occupancy averaged a high 97.7% at the end of 2024. While it dipped slightly over the 3 years, it remained above 95%.
Pretty solid.
Yeah. The report notes that single-city REITs saw slight dips, but cross-regional REITs demonstrated diversification benefits, with some assets maintaining 100% occupancy or recovering to full occupancy in 2024.
And rent growth for industrial parks, up or down?
Average rent growth actually increased to 4.7% at the end of 2024, up from 1.7% in 2023. So positive growth overall, benefiting from long lease terms and built-in increases.
But there was some pressure.
Yes, however, the report mentions specific instances where rent was lowered to boost occupancy. They call this trading price for volume, essentially accepting lower rent to keep spaces filled, indicating some market pressure in specific locations or assets.
Okay, how about the collection rate? Are tenants paying?
The average was 99% at the end of 2024, a slight dip of 0.9% from 2023. It's still very high, showing stable operations and good tenant payment ability, despite some impact from challenging market conditions for certain tenants.
So for industrial parks, generally stable operations, high occupancy collection, positive rent growth, but watch for those localized pressures where they might trade price for volume.
That sums it up well.
Next, affordable rental housing, covering 16 assets. How's that sector looking?
These are mostly in Tier 1 cities and are typically single-city products. Occupancy averaged 94.6% at the end of 2024, down slightly by 2.4% from 2023, but still maintaining high levels overall.
Any issues highlighted?
The report gives a specific example of one asset that saw a significant occupancy drop due to a large corporate tenant leaving.
Ah, concentration risk.
Exactly. But it recovered quickly in Q1 2025. It does highlight the potential risk if these assets rely too heavily on single large corporate tenants.
Rent performance for affordable rental housing. Much growth there.
Average rent increased slightly by 1.7% at the end of 2024, staying quite stable. Pricing in this sector is heavily policy guided, so there's limited growth potential, often tied to things like local income levels or CPI.
Okay. And the collection rate, I imagine pretty good for housing.
Exceptionally good. An average of 99.7% at the end of 2024, remaining stable.
Yeah, almost perfect collection.
Yeah. This high rate is attributed to the essential nature of housing, competitive pricing, and strong tenant payment ability. Overall, this sector shows high stability, acts countercyclically, and has a low-risk profile due to essential demand and price controls.
Good.
But the report flags that corporate tenant concentration risk to monitor.
Got it. Moving to warehousing logistics, 26 assets analyzed. Occupancy.
These are more widely distributed and often cross-regional products. Occupancy averaged 91.4% at the end of 2024. That was actually up 0.7% from 2023, reversing a prior decline.
So improving occupancy stayed at 90%.
Yes, and cross-regional products again demonstrated risk diversification benefits.
Were there regional differences in occupancy for warehousing logistics?
Yes, occupancy improved in the Yangtze River Delta, plus 1.5%, and Beijing-Tianjin-Hebei, plus 4.1%.
Yeah.
The decline in the Pearl River Delta narrowed, shows some regional resilience and recovery trends.
Okay, occupancy up slightly. What about rent?
This is where it gets challenging for this sector. Average rent growth turned negative, down negative 2.4% at the end of 2024. That compares to positive 1.0% growth in 2023.
Rent went down. So that trading price for volume strategy was widespread here.
It appears so. Operators lowering rents to keep occupancy up in a competitive market.
And was that rent decline consistent across regions?
Rent declined in the Yangtze River Delta, negative 2.0%, and Pearl River Delta, negative 1.3%. Beijing-Tianjin-Hebei saw a slight increase, plus 1.1%, but that was relative to a lower base from 2023. So broad pressure on rents.
And collection rate for warehousing logistics, holding up.
Averaged 97.8% at the end of 2024, down 1.2% from 2023. A slight dip, which the report suggests is likely due to some tenant operational challenges, but collection risk remains relatively low overall.
So, for warehousing logistics, operators use price reductions to help occupancy, rent declined, collections slightly dropped, but operations remain stable overall with notable regional variations. Still performing, but under pressure.
A fair summary.
Finally, for the property assets, consumer infrastructure, 12 assets. This is the newer category. How do they do operationally?
These are mostly located in Tier 1 and major Tier 2 cities. They showed strong operational recovery. Occupancy averaged 96.2% at the end of 2024.
96.2%.
A significant increase of 3.2% from 2023. Most assets saw positive occupancy growth after listing, with the average exceeding 95% for relevant assets.
Strong occupancy growth. Rent performance for consumer infrastructure.
Most assets saw rent increases at the end of 2024. Rent levels vary significantly by asset type and location, of course. The report specifically notes Qingdao Vientiane City as having particularly high rent levels, showing how individual asset quality impacts performance.
And collection rate, how did that hold up?
Averaged 99.2% at the end of 2024. A very high rate, reflecting strong tenant attraction and good payment ability despite market competition.
So for consumer infrastructure, showed a strong operational recovery with improving occupancy and rent and high collection rates. Looks like a bright spot operationally.
It certainly performed well in 2024 based on these metrics. The report adds a concluding note here, reminding us that while the analyzed assets are representative, they don't cover the entire market for each type due to the limited number of listed C-REIT assets.
Good caveat.
It emphasizes that looking at the overall market performance for each asset type is crucial for both operators and investors.
That gives us a detailed view into the operational health of the assets powering C-REITs. Really useful stuff.
Oh.
Now let's pivot to a case study the report provides. Japan Hotel REIT, or JHR REIT. They use this as an example of a long-standing successful REIT in a mature market.
Great.
Suggesting it could be a valuable reference for diversifying markets like China mainland that might look to add asset types like hotels in the future.
Exactly. JHR REIT, listed way back in 2006, holds the distinction of being Asia's first hotel REIT.
First one.
Yeah, making it a true standard bearer for the sector. Its focus is on investing in Japanese hotel assets with a diverse and dispersed portfolio.
And its scale today, how big is it?
As of the end of 2024, it holds 51 hotels with approximately 14,000 rooms. Its total assets are around $2.9 billion, and its market cap is roughly $2.3 billion. It's the second largest hotel REIT in Japan by market cap.
The report mentions the manager has deep experience in hotel operations. What's their investment strategy? What do they look for?
Their core strategy is stable growth and income through competitive acquisitions. They primarily target high barrier to entry assets like full service and resort hotels, but they also consider limited service hotels based on key factors like tenant creditworthiness and location.
A balanced approach.
Yeah, the goal is a mix of external growth through acquisitions and internal growth and synergy within the portfolio.
How has it grown over the years, since 2006?
The report notes a significant merger back in 2012. Since then, the asset count grew from 28 to 51. M&A activity understandably paused during the COVID-impacted years of 2020 to 2021.
Right, tough time for hotels.
But restarted in 2022. The asset scale has grown significantly post-merger, at roughly an 11% compound annual growth rate based on acquisition price.
Let's look at that portfolio diversification you mentioned. How's it structured? Location, brand, quality.
It's diversified across several dimensions, which is key for risk management in hotels. By location, it's dispersed across regions like Kanto, Tokyo area, Kansai, Osaka area, and Kyushu, Okinawa, targeting developed and tourism areas to avoid over-reliance on a single market.
Brands.
By brand, it includes major international names like Hilton, Holiday Inn, Mercurabus, and Sheraton, alongside well-known Japanese domestic brands like Oriental Hotel, Nikko Hotel, Dormy Inn.
Good mix. Quality.
By quality, it concentrates heavily on mid-range and upscale hotels, which make up over 80% combined, with some luxury and economy assets for balance. And by service type, it's a mix of full service, about 50%, limited service, around 31%, and resort, about 18%. The report highlights that renovation and rebranding are core strategies they use to continuously improve service quality, income potential, and capital efficiency within this diverse portfolio.
Actively managing the assets. Reviewing its historical operating performance from 2019-2024, the report shows volatility, as you'd expect with global events like COVID, but a clear improvement recently thanks to economic recovery and the tourism boom in Japan.
Performance has definitely rebounded strongly. Dividends are increasing back towards 2019 levels, and the forecast for 2025 looks quite positive.
What are they forecasting?
Projected increases of 23.2% in net operating income and 13.3% in distribution per unit compared to 2024 forecasts.
Strong outlook. The report mentions different operating models within their portfolio.
Yeah.
What was the occupancy like, given that volatility?
The overall portfolio-wide occupancy has been remarkably high, averaging a 99.9% between 2019 and 2024.
99.9%.
How? That reflects the stability brought by fixed rent portions within their lease contracts. Now, for the hotels specifically under floating revenue models where occupancy really matters day to day, occupancy was 83.1% in 2024 and was increasing.
Okay, that makes more sense.
The average capitalization rate for the portfolio was 4.38% at the end of 2024.
How does JHR manage its leverage in Japan, where there's no explicit regulatory limit? Do they set their own target?
They do. While there's no hard limit, JHR has a stated internal target to control leverage, aiming to keep their valuation-based loan-to-value, or LTD, ratio below 40%.
Okay, self-imposed discipline.
Yeah. The report does note that rising interest rates in Japan could potentially increase their financing costs and repayment risk if their LTV were to rise significantly. Something to watch.
One strategy the report gives particular focus to is renovation and rebranding. How does the report show this as a key strategic choice, not just maintenance?
They classify capital expenditure, CapEx, into three types, with CapEx 3 being strategic spending aimed at improving competitiveness, not just keeping the lights on.
Okay.
The trend shows a clear shift. Strategic CapEx spending was significantly reduced during the market downturn from 2020-22, but it increased dramatically from 2023 onwards. It reached about 46% of total CapEx in 2024 and was forecast to be over 50% in 2025.
So reinvesting heavily as the market recovers.
Exactly. It demonstrates a deliberate strategy to invest in upgrading and repositioning assets to capture the upside.
And is there evidence this strategy is paying off? Does the report show results?
Yes, the report provides a specific, quite compelling example. Renovations at the Oriental Hotel Tokyo Bay led to a 45.8% increase in its average daily rate, ADR, in late 2024 compared to 2019 before the renovation.
Wow, almost 46% ADR increase from renovation.
Significant impact. Public area renovations and rebranding efforts are also mentioned as contributing to improved income and efficiency. It really shows active asset management is crucial for success in this sector.
Okay, we've covered a lot of ground, from high-level market shifts across Asia, deep dives into mature markets and C rates, detailed operational performance, and this specific JHR case study. Let's try and pull it all together. So what does this all mean? What are the big takeaways?
Well, I think this deep dive really shows us that the Asian REIT market is not a single entity at all. It's a landscape of significant divergence, maybe now more than ever.
Yeah, divergence seems the key word.
You have mature markets like Japan, Singapore, and Hong Kong grappling with global interest rate shifts and broader economic pressures. They're finding opportunities through specific sector strengths, like we saw with data centers or tourism-driven hotels, and implementing active asset management strategies like renovation or disposal.
Right.
And alongside them, you have the rapidly expanding C-REIT market in China mainland, fueled by policy support, developing its own unique structure, asset mix, and investor base, and showing considerable resilience in its underlying operations, despite some sector-specific pressures.
It really highlights how many different factors, global economics, local policies, specific industry trends like AI or tourism, and even the nitty-gritty of how individual properties are managed, like that renovation example, all come together to shape the performance of these investment vehicles. It's complex.
Precisely. And as the market continues to evolve, with new asset types emerging, regulatory frameworks maturing, and investor bases growing, there's always more to understand about these interconnected but distinct markets across Asia.
Okay, here's where it gets really interesting for me, thinking about the future. We saw these stark differences, particularly in, say, leverage levels, mature markets generally higher, C rates much, much lower. Then yield spreads again, mature markets higher, C rates lower. And price-to-book ratios, mature markets trading at discounts, C rates generally at premiums.
Big differences, yeah.
So what does this divergence imply about the fundamental risk and return profiles investors should expect from these different segments of the Asian REIT market going forward? I mean, will these significant differences persist as structural features of these distinct markets, or could global forces and market maturity eventually push them toward some form of convergence down the line?
That really raises an important question for you, the listener, to consider as you look at this space and think about where the opportunities and risks lie.
Absolutely. Definitely something to mull over as you continue your own deep dives.
Indeed.